wealthbranch.com.
What is the free dividend fallacy? According to research by Chicago Booth's Samuel Hartzmark and University of Southern California's David H. Solomon, the free dividend fallacy is investors seeing a stock's dividend as an income stream separate from the price appreciation of the stock. But what should investors be doing? According to an article titled Dividends Are Not Free Money by Maiello on the Chicago Booth Review website, investors should be indifferent to sources of return after accounting for frictions such as taxes and trading costs. A $1 dividend from a share of stock should be no more meaningful than selling $1 worth of shares, as the share price on average drops by the amount of the dividend when it is paid. Investors caught up in the free dividends fallacy mistakenly view dividend-paying stocks as bond coupons that produces small, stable gains over time. When investors trade based on a stock's performance, they focus on whether the stock has gained or lost money relative to the purchase price. Ignoring the impact of dividends, they focus on price changes, not total return. However, investors who want to receive a dividend stream need to hold on to the stock until it pays out its regular dividend. And Hartzmark and Solomon find that investors tend to hang on to dividend-paying stocks for longer periods of time, regardless of performance. Bonds versus dividend stocks. According to Dirk Cotton contributor on Forbes.com, this false equivalence of bond interest and dividends probably influences some investors to turn high dividend stocks when bond interest is low, without considering the additional risk that equities bring. They are not the same, of course. When a $10,000 bond pays out $300 in interest, the bondholder is still owed $10,000 in principal at the bond's maturity date. When $10,000 of stock pays out $300 in dividends, the value of the remaining stock immediately drops to $9,700 at payout. Unlike bonds, there is no maturity date or any promise of the stock's value at some future date. But if you plan to spend down retirement savings with a strategy based on preferring $1 of dividends to $1 of capital gains, you are betting against economic theory, portfolio theory, historical evidence, tax law, behavioral finance, and the wisdom of Warren Buffett. Where did you get this dollar? As a dividend investor enthusiast, it feels very unnatural to say this, but a dollar is a dollar, and it doesn't matter if it comes from a dividend payment or growth. Some investors do not care if their dollar is organic, grass-fed, or gluten-free. They just want more of them. If you want to find out more, I cover this in depth in my course.